Recessions from history to the next crash sudden, relentless, unforgiving. Recessions arrive like a winter storm, toppling economies and testing lives. But beyond the numbers are lessons that echo across centuries. This is the history of recessions, told not just in charts and statistics, but in stories of resilience. They are the shadows that follow prosperity. Today at Future Lens, we journey through the history of recessions. From the crashes that shook the past to the storms that could shape our future, uncovering the lessons every economy must learn. Our story begins in the 19th century, when industrial revolutions transformed economies. Factories roared, railroads stretched across continents, and banks lent money with optimism. Yet this rapid expansion had a dark twin: collapse. In 1873, the world faced one of the first truly global downturns, the Long Depression. Triggered by the collapse of Vienna's stock market and the bursting of a U.S. railroad bubble, it lasted 23 years in some regions. In America, unemployment climbed above 14%. Banks failed. Farmers abandoned the land. It was the beginning of what economists would call the boom and bust cycle. It was the first time the world realized that progress could come with devastating pauses. Next recession is called the Great Depression. The 1920s were called the Roaring Twenties. Between 1921 and 1929, U.S. stock prices more than tripled. Ordinary citizens borrowed money to buy shares. But on October 29, 1929, Black Tuesday, the market collapsed. Within a week, $30 billion vanished, equal to the annual federal budget at the time. By 1933, U.S. unemployment hit 25%. Industrial output halved. In Germany, the crisis fueled extremism, paving the way for Hitler's rise. Globally, trade fell by 2/3. The Great Depression remains the deepest recession of modern history. The Great Depression also reshaped nations. In the United States, Franklin Roosevelt's New Deal introduced social safety nets, public works programs, and regulations that would redefine the relationship between government and the economy. The oil shocks between 1970 and 1979. The 1970s brought an economic shockwave. Twice in one decade, OPEC tightened its grip on oil supplies, and prices didn't just rise, they exploded, jumping nearly 400%. Gas lines snaked for miles, inflation roared to 12%, and unemployment climbed. Economists struggled to name this nightmare. High prices and high joblessness all at once. They finally settled on a new word: stagflation, the dot-com crash. The 1990s were the age of the internet gold rush. Startups with strange names promised to change the world. Investors poured billions into companies that sometimes had little more than a website. Then the bubble burst. From 2000 to 2002, the NASDAQ lost nearly 80% of its value. Overnight millionaires became bankrupt dreamers, and $5 trillion of wealth vanished into thin air. The digital revolution had arrived, but it came with a brutal lesson. Hype is not the same as value. The global financial crisis of 2008. In the early 2000s, cheap credit and risky mortgages fueled a housing boom. Families bought homes they couldn't afford, banks bundled toxic loans into glossy products, and everyone believed the good times would last. But when the housing bubble burst, the entire financial system began to crumble. Lehman Brothers, a 158-year-old giant, collapsed under $600 billion in debt. Stock markets plunged. Millions lost jobs and homes. Global trade fell by double digits in a single year. For a moment, it felt like the world economy itself was on the brink of collapse. History has shown us how recessions strike: sudden, brutal, and unforgettable. But the greatest question remains: what storms lie ahead? If the past is a warning, then the future may hold challenges we can barely imagine. Now we turn to the horizon. What if the next recessions don't look like those of the past? What if climate change sparks economic collapse? Imagine cities battered by floods and storms. Insurance companies fail under mounting claims. Food prices soar as crops fail. Could climate-driven recessions become the norm, not the exception? What if artificial intelligence reshapes work faster than economies can adapt? Entire industries could vanish overnight. Millions may face unemployment, not from a financial bubble, but from a technological leap. Would governments respond with universal basic income, or would social unrest erupt? What if global trade fragments? Picture a world divided into rival blocks. Supply chains fracture. Energy and food become weapons. In such a world, a recession might not be global but regional. Waves of downturns hitting in unpredictable patterns. And what if, for the first time, we manage to soften recessions? With smarter policies, digital currencies, and global cooperation, could we turn violent crashes into softer landings? Or will human greed always outpace our safeguards? Are we traveling back to 1929? The past has a voice, and it is not silent. From the dizzying heights of stock markets to the relentless surge of housing prices, from the glitter of gold in vaults to the risks hidden in easy credit, the echoes of 1929 are all around us. Each bubble, each surge, each reckless bet whispers a warning. The same patterns that brought the world to its knees nearly a century ago are still shaping our economy today. Stock markets, the euphoria of endless growth. In the 1920s, stock prices soared. From 1921 to 1929, the U.S. market tripled. Today we see similar surges. In the decade after the 2008 crisis, global stock markets reached record highs. Technology giants drove valuations into the trillions. Once again, optimism suggested the boom might never end. Home prices. In the late 1920s, real estate boomed. Florida saw wild speculation. Land prices soared, only to crash in spectacular fashion by 1926. Today, housing prices in many parts of the world, from New York to London to Mumbai, have risen faster than incomes. In 2021, U.S. home prices rose at their fastest pace in 30 years. Easy lending and investor demand once again drive the cycle. Bank lending. Before 1929, banks lent recklessly. Margin loans allowed investors to borrow up to 90% of a stock's value. When prices fell, debts became unpayable and banks collapsed. Today, lending is again aggressive. While regulations tightened after 2008, new risks have emerged: shadow banking, private equity, and fintech lending. Household debt, corporate debt, and government borrowing are all at historic highs. Gold prices, the eternal refuge. In 1929, the gold standard tied currencies to fixed reserves. When banks failed and confidence evaporated, people clung to gold as the only true store of value. Today, whenever markets tremble, gold rises. In 2025, gold prices surged to record highs above $3,600 per ounce. Once again in uncertainty, humanity turns to the metal that never rusts. From stocks to homes, from banks to gold, the patterns of 1929 live on in the present. The question is not whether history repeats itself, but how, and whether we have learned enough to survive the next great fall.